And let's now welcome in the management at Equitas Small Finance Bank. N Vasudevan, MD and CEO at Equitas Small Finance Bank, joins us. Sir, your loan growth has been quite strong in the quarter three. You've given an update. Talk to us about top contributors to your segment of loan growth. What is standing out for you?
Yeah, see, there are two areas where it's really been doing strongly. One is our small business loan, which is our flagship program. Nearly 40% of our loan book is in small business loan. These are businesses which are very small businesses run, by people, and they take a loan typically in the range of 3-4 lakhs to 7-8 lakhs, 10 lakhs. That's the kind of loan size that they take and secured by their house property and for running their small businesses. So that's our flagship program, and that is one thing which has been growing at a very strong pace. The second thing is that we have recently introduced a merchant overdraft facility, merchant OD as we call it. For the small businesses, we have introduced a OD product, and that's again been something which has really taken off very strongly. And the affordable housing finance segment that we started pre-corona, but then it entered a lull during the corona period, that's again picked up momentum, and that's also growing very strongly. Today, our affordable housing portfolio is nearly about 9% of our total book, which used to be 4 to 5%, about a year back. So that's again a segment which is doing strongly. Besides this, our traditional businesses, which is commercial vehicle, that continues to be contributing 25% to the total book, and microfinance, which continues to contribute over 18% to the total book. They've all shown the regular levels of growth. So it's kind of, I would say it's evenly spread. The growth is evenly spread across all our product range with specific extra contribution from our small business and the affordable.
Right. Mr. Vasudevan, with higher growth also comes high risk, right? So how is it that you're looking at credit costs and risk on especially these new loans?
So, see, if you look at our product mix and the segment that we deal with on the loan side, there's really been no change. Before Corona and after Corona, there's really been no change. We are continuing to pursue the same segment of borrowers, which is principally the borrowers from the informal economy. The new to credit, so to say, new to credit segment. That's what has been our focus pre-Corona and post-Corona also. So, to that extent, we don't expect our risk profile of the portfolio to change pre-corona and post-corona. We don't really expect that to change. And pre-corona, our average annual credit cost used to be in the range of 1 to 1.1%, which went up during the corona period. And now this year, it is coming back to a little bit of normalcy. So around 1.5% we expect it to land for the current financial year. But going forward into the next financial year and thereafter, we should aim to get our credit cost back to that 1.1 to 1.2% levels. So I don't see that there should be any change in our risk profile just because of the growth, because the segment that we deal with is exactly the same as what we have dealt with right from the beginning.
So, Vasudevan, while the rest of the industry is facing the issue of the deposit growth lagging the advancing growth, yours is pretty neck to neck because the gross advances on a quarterly basis has gone up by 9%, and the deposit growth too is matching with the 8% growth, at least on a sequential basis. Could you talk to us about what is your expectation, how deposit growth is likely to pan out? Are you expecting maybe the pace to be faster from here on?
Deposits grew by 31% year on year as of December, and within that, our CASA has grown by about 19% year on year, and the remaining is basically contributed by term deposits. Our CASA percentage continues to be fairly robust. It's around 46 and odd percent, but it's of course come down a bit compared to the 50% that was there about a year back. So there is a little bit of a reduction in the CASA ratio, but still at 46 and odd percent, I think it's fairly robust CASA ratio that we have today. See, one is our interest rates. Of course, that is an attraction from an interest rate perspective for a potential depositor. But besides that, we have been, doing a lot of other work. Our digital programs have actually taken off very strongly. And today, the savings account balances from digitally sourced accounts is almost contributing 9% of our total savings account balances. So this 9% is a complete addition to the savings account balance, which wouldn't have been there about a couple of years back when we did not have a digital acquiring program at all. So there's been a lot of push, both physical and digital, and as a result, we have been comfortable in seeing a pretty strong deposit as well as CASA.
Thank you so much for telling us about your Q3 update and explaining us what led to those recoveries. On that note, we're taking a break, leaving you with Nifty up about 230 points, looking in solid, taking cues from US markets on Friday.